Understanding homeowners and renters insurance is crucial for protecting your property, legal liability, and financial well-being. This podcast will review 5 things you should know about these policies to make informed decisions, maximize benefits, and cut costs. Welcome back to episode 914 of Money Girl. I'm Laura Adams, an award-winning author, spokesperson, money speaker, founder of The Money Stack, that's my Substack newsletter, and host of this podcast with over 43 million downloads. If you're new here, welcome. And if you've been with us for a while and you're enjoying the free content that we love creating, please take a moment to rate and review the show in your podcast app. And if you have a question, maybe it's about money or small business, leave it on our voicemail at 302-364-0308. I'd love to cover it on a future show. And you can also visit lauradadams.com to email me directly. And that's where you can also learn more about my books, courses, and the free Money Stack newsletter. All right, so let's talk about home and renters insurance. Whether you own a home or you rent a home, having insurance is an essential financial safety net. It protects you from some pretty devastating potential losses. And we're going to go through 5 things you should know about homeowners and renters insurance, whether you already have a policy or maybe you're new to these policies. So the first thing to know is that not every kind of damage is covered. So when you purchase a standard homeowner's policy, it pays for a set of claims up to certain limits. So let me go through what is covered. You're going to get dwelling coverage. So this pays to repair or replace property. So this is the structure of your property that gets damaged due to a covered disaster. That might be a fire, a tornado, a hailstorm, a windstorm, or vandalism, theft, those sorts of things. You're also going to get personal property coverage that pays to repair or replace your belongings. So these are the things inside your home or inside your outbuilding, like furniture, electronics, clothing, and jewelry, up to policy limits. And again, it's if you have damage or a theft, damage due to a covered disaster, like a natural disaster, a theft, or other type of loss. You also get liability coverage. This protects you if you get involved in a lawsuit. So let's say somebody comes over to your home or your rental and they fall and hurt themselves. You also get additional living expenses coverage, or ALE. This pays for your lodging and your meals if you can't live in your home or your rental after a covered disaster like a fire or a storm. Now, if you're a renter, you also need insurance. Your landlord likely has insurance for the structure of your rental, so the dwelling coverage, but they're not going to insure your personal belongings or your liability. So renter's insurance gives you the same protections as a homeowner's policy, except for the dwelling part. So you're going to get coverage for personal belongings, liability, and additional living expenses. And that's why renter's insurance is much less expensive than homeowners. But unfortunately, many renters skip insurance because they either mistakenly believe that their landlord would pay to repair or replace their damaged or stolen possessions, or maybe some think that a renter's policy is just too expensive. Now, I want to tell you that renter's insurance is not expensive. The good news is that a typical policy is very affordable. It costs just $170 a year on average across the United States. So that's an average. So some states are going to be less than that. While home and renter's insurance gives you significant coverage, I want to make sure you understand that it doesn't extend to all natural disasters. Some are expressly excluded, such as earthquakes and flooding that happens from groundwater. So if you live in an earthquake-prone area, you can typically add earthquake coverage to a home or renter's policy. However, flooding is different. This is kind of like a whole different category of insurance, and you've got to purchase flood insurance separately. And you can purchase flood insurance as a homeowner or as a renter. It can, cover the dwelling as a homeowner or just your personal possessions as a renter. So flooding, again, it gets handled differently than other disasters because it is the nation's most common and expensive disaster. Floods can happen anywhere, so don't think that you have to live on a lake or, on the beach in order to be prone to flooding. They really can happen anywhere, and they don't have to be catastrophic to cause significant, expensive damage to your home or your personal belongings. If your town or community participates in the National Flood Insurance Program, you can buy flood insurance for your rental or home through that program. And if you purchase a home in a designated flood zone, mortgage lenders typically require you to have flood insurance. And even though the federal government backs flood insurance, it gets brokered or sold by regular insurance companies or agents. And you can learn a lot more at floodsmart.gov. Most flood policies do have a 30-day waiting period, so you can't wait until a storm is bearing down on you to sign up. That would be too late. And remember that water damage from rain, winds, or let's say a tree that falls on your roof, that is covered by a standard home or renter's insurance policy. However, damages to your home or personal belongings that happen due to rising groundwater are not insured except up to the limits of a separate flood insurance policy that you purchase. Also note that you typically need business insurance if you have a home-based business like, with inventory or any specialized equipment, or you see customers who come to your home. Likewise, if you turn your home into a rental, like, an Airbnb or a vacation property, you generally need additional coverage as a landlord, like a landlord insurance policy to cover those people who are renting your home. With home and renter's insurance, your belongings are insured outside of your home as well, which is something many people don't know, and this is called off-premises coverage. For example, let's say your laptop is in your car, but somebody breaks into your car and steals it. Or maybe you're on vacation and your luggage gets lost with your expensive jewelry. Well, your homeowners or your renter's policy would cover those situations up to your off-premises policy limits. All right, the second thing that you should know about home and renter's insurance is that certain belongings have low coverage limits. So just like every disaster is not covered, not all personal belongings are protected by a home or renter's policy. Some belongings like cash or bullion, like gold or silver bullion, are never, ever covered. And others are covered, but they have very low caps. For instance, jewelry, watches, furs, silverware, electronics, and firearms are typically limited to just $1,000 or $2,000 of coverage. Therefore, let's say you've got jewelry worth $10,000 and it gets lost or stolen. You would come up with a $8,000 shortage if you only had $2,000 of coverage. Now, if you have items that are worth more than the insurance coverage caps, you can add an insurance rider to expand the protections for that specific item or that category. This addition is known as scheduling your personal property. And yes, it does cost more, but not a whole lot more. And it gives you much more coverage and certainly more coverage on your expensive items so that you can replace them if they get damaged, lost, or stolen. So you want to pay attention to the insurance limits for the possessions that you have inside your home and also what would be the off-premises coverage outside of your home. And consider adding a rider or a property schedule to boost coverage when needed for valuable items. The third thing to know is that there's a big difference between actual and replacement coverage. So knowing how much money that you'd receive from a renter's or a home insurance claim can be a little confusing. So I want you to be sure you understand the different types of policies you can buy. One is called actual cash value or ACV coverage. This pays to repair or replace your property or possessions up to the policy limits minus a depreciation deduction. In other words, it pays a percentage of what it would cost you to go out and buy the same item. For instance, let's say your couch gets destroyed in a fire and you have an ACV, an actual cash value policy. Your coverage won't pay the cost of buying a brand new couch. Instead, your insurance provider will pay the couch's depreciated value, which could be pretty low. And again, it's the depreciated value before the disaster occurred. And you'd have to pay the difference. So if your, couch cost $2,000 right now and the insurance company says, well, its depreciated value is only $500, that's all you're going to get. You would have to come up with the balance, the $1,500 balance out of pocket. And while an actual cash value policy does cost less, it probably won't pay enough to rebuild your home or fully replace your personal belongings without you having to pay a significant amount out of pocket. If you want more coverage, you need a policy with replacement cost value, or RCV. It costs more than an actual cash value policy, but would pay you enough to rebuild a similar home and replace your damaged belongings, of course, up to limits. And there are also guaranteed or extended replacement cost policies, which give you even more protection. They pay to replace your home as it was before a disaster, even if it costs more than your policy limit. Remember that a home insurance policy is based on the cost to rebuild your home and any outbuildings, not the amount that you paid for the property or even its appraised value. It's all based on what it costs to build. So what are the construction costs? You never include the value of your land in home insurance coverage. And depending on your home's age, location, and construction quality, the insured value could be much higher or lower than its market value. The fourth thing to know is that there are special disaster deductibles. So a deductible is an amount that you're responsible for paying for an insured loss. And in general, the higher your deductible, the lower your premium will be. So you want to get quotes for different deductible amounts when you're shopping for renters and home insurance. But also make sure you can afford to pay a higher deductible if you choose to do that in order to reduce your premiums. In some high-risk areas, you may have separate deductibles for damage caused by certain disasters. And according to the Insurance Information Institute, 19 states and the District of Columbia have hurricane deductibles. And I know all about this since I live in Florida. These special deductibles are additional and separate from the regular deductible for all other types of claims, like fire and theft. A hurricane deductible applies only to damage from hurricanes. And there also are windstorm and hail deductibles that would apply only to damage caused by those disasters. Hurricane and wind deductibles are a percentage that could vary from 1% to 5% of a home's insured value, and they can even be higher than that if you live in some coastal areas. The amount you must pay depends on your insured value and the trigger event. So let me explain. Let's say you have a 3% hurricane deductible and your home is insured for $200,000. In that case, you'd be responsible for the first $6,000 in repair costs that are due to a hurricane. So that's $200,000 times a 3% hurricane deductible. So paying $6,000 out of pocket is definitely more expensive than a standard home deductible, which might be, $500 or $1,000. Now, in some states, the triggering event for hurricane deductibles to apply is anytime a Category 1 storm causes damage, whether it made landfall or not. Other states may have made Category 2 storms the threshold. In others, a hurricane deductible applies from the time a hurricane watch or warning gets issued to 72 hours after it ends. And a hurricane deductible can only be applied once each hurricane season, and that's from June to November. All right, the fifth thing to know is that there are ways to reduce your insurance costs. When it comes to the price of renters and home insurance, some factors you can control, but some you can't. So to help you get the best price possible, let's review some of the ways that are in your control that can help you save. One is bundling insurance. This is when you purchase various policies from the same insurance company, like your home and your auto. But you want to check that the combined price from one insurer is less than buying policies separately from different insurance companies. Also, certainly just shopping around. This is critical because prices vary considerably from insurer to insurer. Compare home insurance quotes from, I'd say, at least 3 companies for the same exact coverage and deductible. So you're getting a really good apples to apples comparison. You might consider installing safety devices in your home like smoke detectors, alarm systems, deadbolts, storm shutters, shatterproof windows, and weather-resistant roofing. All of these things make your property less risky to insure. So they're making your property, more resistant to disasters. So find out from your insurance company, what they are looking for in terms of safety features, and some may really pay for themselves. The cost to install it may be less than the discount that you're going to get on your coverage. Also, as I mentioned, raising your deductible cuts premiums. Just make sure you can afford to pay it in case of a claim. Also, the savings can vary depending on where you live and your insurance company. So get quotes with multiple scenarios. Get quotes with different deductibles so you really can tell if raising your deductible is going to save you enough to make it worthwhile. Also, maintaining good credit is critical for getting lower rates on home, renters, and auto insurance. Depending on where you live, having poor credit can cause you to pay double or triple the premium for your home insurance compared to having excellent credit. Now, there are some states like California, Maryland, Massachusetts, Michigan, Oregon, Hawaii, and Utah that either prohibit or restrict the use of credit when setting home insurance rates. And being loyal, sticking with an insurance company for several years may qualify you for a significant discount. However, don't let that keep you from periodically shopping around to ensure you are getting the best deal possible. When disaster strikes, you're the victim of theft, or you get involved in a lawsuit, having a home or renter's insurance policy can be a financial lifesaver. Take the time to create a detailed inventory of your possessions, including photos and receipts. That will definitely simplify the claims process if you ever experience a loss. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team I want to thank. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.